Like this
Oh, yeah.
market is so much bigger than I think anybody has an understanding of.
When you hear things like it's a $1 trillion market, we're so used to big numbers.
Yeah.
But $1 trillion being spent every year buying ads is crazy. Advertising built Google. It's generating all the profits at Amazon. We know Apple's lurking. So just an absolutely massive market.
Hello, fellow data nerds. My guest today is Tim Vanderhook. Tim is the co-founder and CEO of Viant Technology, a public ad tech company with the NASDAQ ticker DSP, and that powers digital advertising through its identity-based platform. Viant even acquired Myspace, if you remember them, from Newscorp in 2011. Viant went public in 2021. Tim, welcome to World of DaaS.
Yeah, thanks for having me, Oren. Great to see you.
I'm very excited. What did you say?
Excited to chat with you today.
Oh, I'm super excited to chat. Absolutely. All right. Now, let's dive into, I mean, we can be a bit all over the place since we're both kind of like OGs in ad tech world. You're more of an OG than I am, but let's talk about ad tech fraud. Like what's the scale of the problem?
Oh, ad tech fraud. Well, I mean, the hardest part is just describing what fraud is. You have things that are not necessarily fraud, but certainly low quality, like made for advertising websites was a big discussion earlier this year. But let's say those are low quality, not fraud.
Yeah.
When I think of fraud, I'm thinking bots.
Yeah.
That ads are going to bots and not to humans. And if you look at the bigger players like IAS or Double Verify, they'll tell you this is a sub 5% problem on any given campaign with roughly reputable publisher partners on there. But there's some new technologies that have come out, like Dr. Augustine Faux, an MIT scientist. He's created Faux Analytics, which is giving new insight into bots. And his numbers are between 25 and 35% on any given ad campaign. So based off of Dr. Faux's analysis, it's a bigger issue than we originally thought.
Now, if I'm a scammer and I run like a random site, the Oren Hoffman movie review, random site kind of thing, then I definitely have like an incentive to create bots to go to my site to pump up the ad impressions. But like if you're running ads on ESPN or something, like is there fraud that could come in there?
Yeah, it's actually interesting. When you talk to the experts in this space, what the bots need to look like humans. And so they'll visit advertiser websites, they'll visit publisher websites.
Got it. So they need to go, they visit the ESPN first to look like a human. So then when they go do the fraud somewhere else.
Exactly. And then hit their own operated inventory. So that's been a big issue. And these guys, it's very cheap to buy a domain name. And really, they used to have to steal content. Now you're seeing they're not even stealing content. Because using things like headless browsers and all types of way to try and get through without actually even hosting content and paying for web hosting. So the sophistication level is very, very high when it comes to ad fraud.
Interesting. And so for like somebody like you that's like in the advertising business, obviously you don't want like your clients' dollars going to waste and stuff like that. So is it just like a cat and mouse game every week of dealing with it, is everyone in the same boat? And so there's like a collective action, or is there some people who are benefiting from fraud more than others in the ecosystem?
Yeah. Well, when we look at, where does the fraud originate? It's hard to put your finger on a person or an organization that's doing it, but you can see the bad actors popping up. And so if you take this approach of, hey, we just won't buy ads on this big giant block list of domains that are there, the fraudsters have another 1,000 domains ready to spin up as soon as they shut the other 1,000 down.
Correct.
So I would say historically, it's been a cat and mouse game. The go forward is now entering the world of artificial intelligence, being able to train it on what fraud looks like in a more real-time environment and making a prediction on whether it is or isn't fraud. From the buy side, that's where we see the future going. That's where a lot of our internal efforts is making that same decision right prior to purchase, so you don't buy unknowingly a bot and then it comes through and what a waste of money for ads going to bots. So more and more you're seeing artificial intelligence in real-time decision-making, and only AI can do that very effectively. Obviously, historically, we've had machine learning to kind of do it, But as domains get shut down and pop up every single day, and IP addresses rotate between the bad guys, making that real-time decisioning is pretty critical. And there's new companies like Dr. Fo, who's come out and he evangelizes all over for you to look at with the bad actors, working with experts like him as well to improve the way that we go to market has been huge in gaining a leg up in this market.
But let's say there's a privacy safe person who's going to visit ESPN.com or something like that, and they're a legitimate person, but they're going in Safari and they're somewhat privacy centric. Yeah. And then separately, there's a bot that's going in kind of like to ESPN. I'm like, how would you know one from the other? Like, how would you know one's a bot versus one's a person?
Yeah, I mean, one of the easiest ways is to figure out bots run on servers inside of data centers. And so you're trying to identify what does a server look like versus, say, my handheld iPhone or my MacBook that I operate on. And a lot of things that you'll see, too, is the number of cores available on the machine, where a server that's being used as a bot will have, let's call it 60 cores or more that are actually inside of that server.
Oh, and you can see that when that request
Absolutely.
comes in.
Absolutely.
Oh, interesting.
So
okay.
you can look at the device itself and what it's capable of handling. And when you see very high powered devices like a server in a data center, that's usually sign number one.
Okay, so a bot isn't necessarily just like, because I would assume it could be buying like gazillion iPhones and running it off through there
too. That on social media in China where they've got them all on the wall. Yeah. And those are farms. Those are effectively farms, and those are hard to detect as well. There, you've got to look at other things like network signals. How are they accessing the internet? Where it's coming from? So there's a million different data points that you could analyze at any given time. And the truth is, it's a hard problem to solve. But I think from our side, since we represent the buyers of the advertising only, we're taking a much more aggressive stance in bringing commercial products to market where we're not going to buy everything that we bought historically because we now know more.
You want to buy, you want to have a 99% belief that it's not a bot before you buy or something like that. And then even if so therefore you will like not buy good users.
Exactly. And you're using artificial intelligence to create predictions kind of in real time on the fly. And as the bad guys change, hopefully the AI detects it and can change very, very quickly as well. Because like you said, the cat and mouse game, it's a real game. There's new approaches to it. And when you're the buyer of the ad, you'll find out over time. But then what do we do different today than we used to do before? And that's real-time decisioning.
Now, on the data front, what kinds of data are advertisers most interested in right now?
Yeah. I mean, broadly speaking, you're seeing third-party data get replaced with first-party data. And I think that's a generic term. Like the word data is generic. So we got to break it down a little bit. CRM data, their customer data is being used tremendously. And everyone looks at the big platforms like Amazon and say, what has that company done so brilliantly? And it's leveraging transactional data, and advertising has been probably the broadest move into first-party data. But it's your CRM data. You want to put that into action. Yeah. And what is that replacing? It's replacing retargeting. It's going after
like a custom audience or something like that.
Very much like custom audience. And I do think more and more you're seeing third-party data providers starting to offer data enrichment. And so if the old way was third-party data marketplaces, and now I'm Hulu and I know who the subscriber is, but I don't know anything about them, the gender, the income level, the education level, whatever it may be. So I do think for third-party data, they're going to be enriching first-party data of advertisers and publishers on a go-forward basis. So more and more, everyone used to activate on third-party data. Now it's, I've got to match Snowflake or whoever their platform is that they're using, their customer data. They want to activate it in advertising. And it's really two use cases. The old way, Oren, when you were still heavy in ad tech, it was all about targeted advertising. It was finding that exact audience segment. Now that data is used equally or more for measurement purposes, just to answer the question, what am I getting for my money? In a world of cookies or single devices or very few devices where consumers would browse and buy on the same device, in an omni-channel, omni-device world, it's very hard for marketers to understand what they're getting for their money. And so first party data, the first use case that we talk to customers about is using it in measurement of advertising. Let's first understand what we're getting for the.
Got it. So did this person then later on engage with your brand, and did they have a higher propensity to engage with your brand or something like that?
Exactly. So I would say measurement's been the big area where first party data and understanding or enriching that data to get more insights. Kind of the original principles, just a different way and kind of order than what
back in like the day, pre-internet, when like Crest wanted to do measurement of like a TV campaign or something, they would run like a specific TV campaign in Phoenix and not run it in Tucson or something, and then they would try to see the lift if that lift happened in Phoenix, but that would come, take a long time, could take like many months later. So obviously, kind of an expensive thing to run before you can kind of learn. Is that the type of thing that's like still going on today?
Oh, absolutely. Geographic holdouts is very, very common. I would say in measurement, the most exciting part or the report that everyone looks at is measuring incrementality. If you're Coca-Cola or Ford, there's a certain percentage of customers that are going to buy your product this week because they buy it every week.
Yep.
So the question, and I think most marketers, digital advertising did a good job at data-driven decisioning and measuring what you're getting and trying to figure out how to attribute what drove it. But that no longer is the reality today. We used to log into DoubleClick, and you'd be able to attribute 90+% of the conversions to who drove it. Now when marketers log into DoubleClick, they can attribute maybe 30% or just Chrome within that ecosystem from a last touch attribution. So there's I think that has created the opening for all new ways of measurement. And you're right, geographic holdouts. I think panel-based methodologies are going to come back in the near term. And you're always going to have a bucket that's addressable and measurable. And I think there's always going to be a bucket that's not addressable and therefore less measurable, but still really, really important. And we even acquired Iris, which provides an ID. It's a content ID. And we think Iris, the potential to move to still do bidding, buying, and targeting and measurement against a content ID in non-addressable environments. So,
guys, it's like, so even back in the day, you would buy a specific magazine or you'd buy a specific, TV show or something like that because of the types of people that would be, the types of audience that would attract.
Absolutely. So there's contextual relevance of the content. Like I'm Bass Pro Shops, and if I target Western sports like bull riding, fly fishing, you're going to sell more fishing lines than if you're on Bloomberg. So there's that contextual relevance there. But I think what Iris provides from a universal ID. So we make it available to everyone in the ecosystem. Think of it as the MPEG file loaded in the content management system that's going to be consumed or viewed. That MPEG file gets put into a number. And therefore, I don't know what you're watching, but I know when Bass Pro Shops targets that number, the conversion rate is pretty similar, whether it's that video was watched through Hulu or Vizio or LG, because content comes out in many different apps as well. So it really is a global video ID, regardless of the app where it's consumed, that as a marketer, you can buy it and bid against it and have predictable returns. And we think that's going to be a very privacy-friendly, unique approach to bidding and buying, but not around addressable targeting.
Now, people have been predicting like the decline of linear TV advertising for a very long time. And it seems like just in the last couple of years, have we actually been really seeing that decline happen very, very, very fast on the linear TV? What's your prediction on like the linear TV world and then where those dollars go?
If you're enjoying this podcast, please sign up for our newsletter. Go to worldofdas.com. The link is in the description below. Now back to the video.
Well, linear TV is such a unique world. I think it ends in a huge cataclysmic explosion because what you have is content owners license their content. And then to license the content, you have to guarantee a number of subscribers if you're an MVPD like DirecTV. And so your content costs go up as the lower subscribers you have, and you're not going to be able to meet the needs of writing the check for the content to get it in to offer that MVPD service if the declines on the consumer side switching to digital versions of MVPDs like Fubo or even DirecTV Stream, which is the streaming version. So I do think it ends in abruptly, given those dynamics of the way you have to commit content costs and subscribers. So to me, I think it probably has 5 years or less before it's now all digital versions of MVPDs. But I do think MVPDs serve a place in packaging and bundling content.
And these content channels, like they still have a premium. They still command a premium. Like, my YouTube TV bill is like, I don't know, $85 a month or something like that. So I pay over $1,000 a year to basically watch football. And I've got the football package on top of that, which is probably a few $100 a year or something. I never do anything else on quote unquote live TV. So there's some other still, is it just sports that can command that? Or for some reason, I assume even though I never watch CNN, I assume CNN is still commanding something on YouTube TV.
Oh, I mean, definitely. Live sports equals the NFL. I think if you look at the just this last year, out of the top 100 shows by viewership and mass viewership, 94 out of the 100 were NFL games.
Well, what? Wait, 94? So 94. Even more than like the NBA finals or whatever?
And the one below that, I believe, was the college football championships were in there.
So football. So in America, football is the dominant thing. Okay,
by far dominant. When I think of the opportunity, even though the viewership of the content is concentrated to the NFL, that just means the NFL is worth a lot of money because it's mass appeal. When I think of that space and the opportunity, my brother Chris and I are also the founders of Xumo, spelled with an X, now owned by Comcast. And that we always believe you had the traditional coaxial or satellite cable delivering the content. IP-enabled content streaming created much more flexibility, interactivity, the ability to change what is just flat video content. And I still, to this day, believe that Xumo, even though I'm biased and we're the founders of it, is best positioned with Comcast ownership because you buy your internet access from them. They're giving you a TV that will auto log you in to Netflix, Max, all your services that are out there, all through a single bill. And I think Xumo is by far, cable companies are best positioned to win this because they've laid that wire to your home and can offer such outstanding service levels, as well as frictionless in getting from one app into the other. It could be a lot less friction.
And what is going to happen to these like legacy media companies like CNNs that are getting like $1 to $2 a month per person for cable and stuff like that? How are these guys going to are these guys going to all go out of business? Or are they going to somehow are they going to change their business model to like a special subscription where like a small number of people pay $20 a month for it? Or how do you think things are going to change?
Yeah, I mean, number one, just look at the most successful companies in the space. And I think that's where you look at someone like a Netflix, who's pure subscription.
Yeah.
Just the fact that everyone's getting into ads. I wrote a LinkedIn post about this like a year and a half ago when they did the announcement or whenever it was. The available average revenue per user, the ARPU associated with advertising on a monthly or quarterly basis is so substantial, you can almost double your revenue. If you look at the old traditional way,
we certainly can double your profit.
Even more. Because it's 90.
Because I believe Amazon makes more money from profit off of the ads than they do from the retail business.
It's a digital good, so you really have some labor associated, and that's that. But when you really look at the ARPU for an organization coming from ads, it's too great to ignore, which is why Netflix came in. The other reason is, if you want to sign live sports to carry it on Netflix or Prime Video, live sports equals ads. You must have ads. There's time breaks. There's all this stuff. So they have to build all that infrastructure and get it all in place. And I think you're seeing that with the Tyson fight that aired on Netflix.
Yeah.
These are dry runs to getting more live sports content across their app.
Will we start to see like better ads that are like within the live sport? obviously you always see it on like the billboards when you're watching the sport or on the people's jerseys and stuff like that.
Yep.
Like they already have kind of ads built in. But we see more targeted ads that are, where Tim and Oren will see slightly different ads when they're watching the same game.
Yeah. No, everyone's going to see different ads. I mean, the principles of digital advertising, buying the users who are likely to buy your product or service, that's going to continue. I think the exciting innovation, the things that we think about in the future is how do you make an ad like for Bank of America in context to a scene that ended on a beach? You're going to have problems like that where the ads, I do think, will be modified on the fly using artificial intelligence to be placed in context of that episode that you're watching. So
I got it. So it's kind of a continuation.
To a degree,
yeah.
Or just, rather than I'm at a veterinary clinic, maybe I need to be in a jungle or maybe I need to be on a beach. How do you make that advertiser be more in context of the video versus the old way of I want to target my ads at the context category of finance users or whatever. So I think in making the ad relevant to who that audience is behind the content, I think there's big opportunity to improve the results of your ad campaign with that type of approach.
Yeah, like I watched the Tyson fight on Netflix and on the ropes had Experian ads, but they were literally like painted on the ropes. So like every single person who watched the Tyson fight, either whether they were in the arena or they're watching on TV like me, all saw the exact same, Experian ad. But I can imagine in a scenario in the future, those ropes are just green and maybe in person, you'll all see the same thing. But outside of it, you'll see something, if you're watching on TV, everyone will see something different.
Yeah. I mean, Omar, the old Blue Kai founder, if you look at his new business, Rembrandt, very much virtual product placement. So if I'm a content owner, when we looked at the business at Zumo, it was, how much ARPU are we getting? That's number one. But how much time in consumption of the video content is there? The problem with the current setup is someone watches, let's say, an hour worth of content and you have ad pod breaks. And we know that those pod breaks create friction and users leave. They'll change a channel, whatever it may be. So I think the future model, if I were on that side, which we're not anymore, but is you need to monetize every second that a user is consuming your content. Virtual product placement, on-screen banners, things like that. I think you're going to see more experimentation to drive advertising revenue from the moment someone tunes in versus today's setup, which is the old way of a minute and a half or 2 minute pod break every 7 minutes, which creates a lot of friction.
And it's just so like the way people consume content, especially like kind of live, is so different where they may have like a screen on their phone at the same time that they're watching something. My son, who's kind of like crazy, he watches 4 football games at once. So he's got the 4 things all on the same screen, on the big screen. He watches them at once. And then he just kind of like moves around on the sound to the one, if 3 of them have commercials, he goes to the other one that doesn't have commercials, or the one that looks, look, they're in the red zone. He moves to the sound of the one in the red zone. And somehow, because he's younger, he can like bring it all in at once. And I assume like more and more people are gonna kind of multi-watch stuff.
Oh, definitely. I mean, you see the generational changes, multitasking just in general. I think our generation is pretty good at multitasking. We're very used to having something on TV and consuming through our phone. Kids are that on steroids times 10. I mean, even if you look at YouTube videos now, you've got 2 videos playing at once. And I asked my son the other day, how are you paying attention to what's going on? And he explained, no, that he's making fun of this and it's a point of view video. So you need both. But their ability to ingest information is like no generation we've seen. So it's going to be very interesting to see how it changes.
Yeah, it's unbelievable. Now on the data front, like I assume like this third-party data is like going to become smaller and smaller part of the ecosystem, or have we kind of bottomed and it's not going to get any smaller?
I think the cookie deletion already hurt third-party data providers. There's chunks of the market that you couldn't activate spend. Therefore, you had
Safari and
Yeah, so I think a lot of the pain has already been felt. That's there. But certainly you're seeing a breath of fresh air from data companies getting into the enrichment game and trying to work with other parties who want to learn more about their audiences. And it's just rather than activating at the real time ad moment, they're going to be integrating their data to tell you more about your customers for you to learn new insights from. So I still think there's opportunity. I think they've felt a lot of pain that's out there. But I think your point is well taken that it's probably a first party world first and third party world second moving forward. But I see room for everybody in that. Maybe market share changes a little bit.
Now, it also seems like, and there's this joke that in the tech world that everyone becomes an ad network.
Of course. Yeah.
And that joke, it seems like more and more real every day. Like, it seems like every company, you talked about Netflix, which is maybe more obvious, but it's like everybody, Walmart has a massive, multi-billion-dollar ad network. And it just seems like everyone is becoming an ad network. As everyone becomes an ad network, like, does it mean like the ad tech companies, whether it be Viant or all these other ad tech companies, are going to become like more important because they need to they can't all do it themselves and need to power? Or how do you think dynamics change over time?
Yeah, I think we serve advertisers. So I think about solving their problems a lot.
Yeah.
And if you think about an advertiser that's very large, pick anyone, Procter & Gamble, Nike, McDonald's, they're going to work with everybody. They're going to work with Google, Meta, TikTok. They're going to be all over the place. Their big need is understanding what they get for their money from all that ad money being in market simultaneously. And that's a big challenge to solve, and one that data and analytics can really bring lots of insight to tell you how to spend that smarter, or at least that's the long-term goal and the ambition. Everyone else, there's buy side, and we break down the world when we talk to investors or customers. There's really only 4 DSPs. There's a lot of people who say I'm a DSP, but self-service, where you could log in with a username and password and self-direct all your activities. And by size, they're Google, Trade Desk, Yahoo, still a very large ad tech assets, and Viant. Everyone else is just a sell-side pretender that they're a DSP, and they're there to sell you more of the advertising either off their property.
Yeah.
Or not. And that's Google's point of view. It's Yahoo's point of view. So there's really very few buy-side only DSPs. And on the buy side, everyone else is a publisher, and we're going to work with you to some degree. The question is, how do you measure and attribute what drove the sale? And there is no perfect science to it if you're Coca-Cola or McDonald's. You have to make assumptions and make bold claims, but letting data lead you that way.
Yeah, that makes sense. You mentioned Trade Desk. Why have they been so successful? Why is that company done so well? I mean, we both know CEO. We know other people work there. They're obviously super smart, talented people. They've run a great playbook, but they're just so much bigger than everybody else. What did they do right?
Yeah, I mean, a lot of things as an entrepreneur, this, are the right move at the right time. And I think the Trade Desk made the right moves at the right time. Number one, starting with their name, which was the Trade Desk, which is to power and claim allegiance to agency trading desks. That's where the name comes from. So I think, and at the time, agency trading desks were trying to get created, and ad networks were making a lot of money. We ran an ad network back then, and it was very successful. And the DSP became a way to partner with the agencies and drive a lot of spend. Their anti-Google positioning also played really, really nicely. I think it was really strategic that in any world, Google has competitors. So in theory, you can win 20% of the customers in the market by being anti-Google. So I do think both of those combinations of things were the right moves at the right time. But I don't think those same moves, if executed today, would create another Trade Desk.
Yeah, for sure.
You've got to out-innovate. In today's world, you've got to out-innovate, use new technology that's coming to market, be first to market, be the thought leader behind it, and then innovate faster than everybody. And that's the hardest part of ad tech. Just in the long run, we've been in this for 2.5 decades now. In the long run, you can never stop innovating when it comes to ad tech, because there's always someone else out there who's been thinking about a problem for a long time and can execute really, really well. So to me, it's the go-to-market today is very, very different, and it really stems with the use of artificial intelligence on top of this industry that is the big data industry. Programmatic advertising deals in more volume of data than most other industries out there. So it's like a great blend.
The business is so much bigger than even like me, who I was in the business for so long. But if you had asked me 10 years ago, like, could you build a DSP, which is really just like a piece of the business that has a $60 billion market cap, I would have said, no way. Like, that's impossible. Like you're smoking something. Like, I wouldn't even like thought it was possible, let alone like that. So it's just crazy that like these things are happening. Like this market is so much bigger than I think anybody has an understanding of.
I think when you hear things like it's a $1 trillion market, we're so used to big numbers.
Yeah.
But $1 trillion being spent every year buying ads is crazy.
That's super crazy.
That is a huge industry when you look out across. And I think we get lost because we're used to big numbers just in society. You get lost into how big of an opportunity that is because we've seen advertising built Google. It's generating all the profits at Amazon. We know Apple's lurking and they're coming and their app store, their ads for app stores driving huge increases in profitability. So just an absolutely massive market and what a great ecosystem to participate in to try and drive growth.
Now, the agencies are really interesting, and they're your partner, they're your customer. We're seeing two of the very largest agencies that have decided to merge together. Like, how do you think the agency market is going to change over the next few years?
Yeah, I think what you have is a very mature industry that's a service industry. So it's heavy people costs that are there. I think in the future, the answer is obvious. You need productivity gains. And the way you get those is you invest in technology through build, buy, partner, whatever. They'll go through that whole analysis on their own. But that's an industry that needs substantial productivity gains to continue and be, more compelling.
But they've tried like over the years, like every few years, they buy some sort of tech company and like it just does either the antibodies for whatever reason doesn't work, and they go back to that kind of more service oriented thing.
And I do think that's going to change because it's how they get paid by customers. The traditional ad agency holding model is one of temporary staffing. If you're GM, you need 1,000 people to run your advertising account. They hire them, they fill the roles. I think where you're starting to see lots of discussion is advertisers talking to agencies about producing outcomes with the ad budget. And in a world of outcomes, you're able to change the way the compensation model goes.
Yep.
So I do think the compensation model of the historical agency model has held them back from really investing in technology. But you're seeing the early discussions have now moved to outcomes. We'll see if that's followed by action by the actual advertisers.
Are there like if you had to kind of like think about like generally the winners and losers over the next decade, are there like non-obvious kind of categories that you would be thinking about?
When I think of winners and losers, it's really about price dislocation right now. Yeah.
Okay.
And I think when I look at where is the carnage is in linear television right now.
Yeah.
I do think out of home historically has had a lot of carnage, and billboards in strategic locations work really well.
Super well.
Of notifying the general consumers about whatever it is, the product.
Yeah.
So I think there's been the most carnage in linear TV, and I think there's probably a lot of value to be had there, given where they're all trading right now. And so you're seeing a lot of M&A trying to take advantage of that potential future value creation. That being said, if you were linear only with no streaming assets, you're in a real tough spot. I'm talking about just simply transitioning that content to a streaming platform. There's a lot of uncertainty in that market, so values are down. And I bet a whole bunch of people are going to make a whole bunch of money by picking up linear TV assets that are probably undervalued right now for the entertainment value they deliver.
This idea of like a network or a channel you and I grew up and we would go to like Channel 7,
Yep.
ABC or something like that. Or even when there's cable, maybe we didn't exactly know the channel, but we'd go to MTV and we'd
Yep.
turn it on and we'd watch MTV or something like that. Like all of that has gone away in the last 10 years. I mean, there's still some people who are like over 60 that may do that, but like there's very, very few, or maybe some people still like they're news junkies and they still go to like these news channels and they watch them. But even
Yep.
those are like, really starting to go down pretty dramatically. Like we still may have an allegiance to a show or something, but like I don't know that my kids know any like who produced it, where they produced. Like they might know they can find it on Netflix versus on Disney Plus versus Hulu or something.
Yep.
But that's about. Sometimes they don't even know that. They'll just like go to the Apple TV and put it in, and it'll tell them where it is.
Exactly. I mean, the linear TV world was asking too much of consumers. You need to show up in front of a TV at this time if you want to watch this show.
Yeah, it's crazy.
In today's world, no one can do that. So it makes sense. Everything's on demand and the ability to pull it down. And what does that do? It grows consumption because I get to watch that show on my time when I actually have the time versus that set time frame. So I do think it just grows the overall category of consumption by having more flexibility on how you can access that content. And that's going to grow the overall category and pie for CTV.
Now, like podcasting is growing, and more and more podcasts have ads, but they have like old school ads where like, it's like the Lex Friedman ad is for everybody who listens to Lex Friedman. And it's like, and then almost like it's him reading a script almost like it's really old school. It's like really going back to like the 50s of like him reading a script about why he likes this particular shampoo or something. And it goes out to everybody. Now, I know that the amount of dollars spent on podcast ads is really tiny today, but how do you see something like that evolving?
Oh, I mean, streaming audio over the last year was growing, probably the fastest grower of all channels. We said on our last earnings call, it now represents 10% of ad spend across the platform.
Wait, what? Streaming audio is 10% of ads?
And a lot
of that.
Holy,
I had no idea it's that high.
And it's growing gangbusters. And so what's great about podcasts, there's similarities and differences. The similarities is you have high attention by consumers when they're listening to podcasts or watching an NFL
as opposed to like music where it's like in the background.
Social media, you might get me for a split second.
Yeah, it's a good point.
I'm looking at different stuff. So it's very, very high attention relative to pricing, relative to CTV, because it's more audio. It's usually cheaper, but you have the same level of consumer attention. And so we see audio driving huge contributions to incremental conversions by advertisers who are measuring it. And so I think streaming audio could get as high as like 25% of the spend of a marketer. I think TV, if you look at the historical, it's always been around half. So combined, that's 75% of marketers' budgets. And it's because you have such high engagement by consumers, the impact of the advertising is substantial relative to a banner ad, relative to a billboard on the side of the freeway.
Yeah, it's really interesting. Now, a few questions about being a public company. So first of all, like your ticker is DSP, which I love. Yeah. It's just great branding. And, a few other guys did it, like Salesforce did that with CRM. I know Nextdoor did that with Kind, KIND.
Yeah.
But it's pretty rare for companies to like brand their ticker. Like, why did you do that? And why don't more companies do that?
Yeah. Well, our biggest issue when we went public, we were trying to solve a lack of awareness in the industry problem. There's also balance sheet and all other reasons to go public. But
because you could have been like Viant, like VINT, or I don't know, would have been something like that, VNT or something,
Basically, no one knew who Viant was. Everyone knows what a DSP is. So we wanted to put the association together. And we were clearly thrilled when we looked up the ticker and it was available. And it felt right from the very beginning to associate what are we? We're a DSP. Let's put what we are as the ticker to drive the association to investors, customers, partners. So everyone understands we are a DSP. And I think it's a pretty clear sign to our customers that we're going to be buy side only for the long tenure of
right, because it's like hard to change your ticker. Yeah. Exactly. And why do you think more people don't do that? Because like you could imagine, like most people, it's like some sort of shortened version of their name or something.
Yeah. I mean, I think if you're a company with huge awareness, the ticker of your name makes a lot of sense.
Yeah.
But I think if you're a company, a B2B company like Viant, that's a small cap, it's very hard to stand out. And like getting to being a public company, very few amounts of companies are public companies. But even amongst the public companies, very small amounts of companies are who investors are keyed off of. So
yeah.
Even when you get public, it's like there's another door in the private club you just got in that you've got to get through as well. So it's a never-ending mirage that we're forced to deal with as well, is just driving awareness that, hey, we even exist. Just look up the ticker, then they'll analyze the financial performance. But it's hard being a public company. Even once you get there, we've been public now since 2021, and it still feels like every other meeting, I ask people, hey, do you know who we are? And they say, no.
Yeah.
Never heard of you. And it's like, 25 years in, no one's heard of us. So yeah, it's from marketing matters a lot. And that ticker symbol, the association, we try and be really thoughtful when we came to market. And it felt right from the very beginning. So we just rolled with it.
Now, being public in some ways gives you more credibility. So I assume if you're like working with customers, or they have a more of a sense you're going to be around. And is that part of the reason that you went public? Is just like the credibility that it gives you?
Absolutely. And as well as having public financials goes a long, long way when people are evaluating partners. And so like we have a really strong balance sheet, $200 million of cash, no debt. We generate cash flow every quarter, EBITDA profitable, all the great aspects of a great company. But now it's public for everyone to see. So if you are,
because if you just told customers that before, they wouldn't know that if you were telling them the truth. But now it's like it's there. It's like anyone can go see. You can go look it up on Yahoo Finance or something.
Absolutely, and that's a great part of being public. There are major negatives to being public, like when our stock price went from post IPO high of 69 down to 330 or whatever it is, the same amount of cash we had. That too is public. So it is an adjustment in running it, but after 3 years now, and we've already hit rock bottom. Once you're there, you're like, well, it can't get worse for the most part. So,
what is it like? Because I'm sure there are weeks where your valuation changes by 10 to 20%. Nothing in the business has changed, and sometimes it's 10 or 20% up. It might be 10 or 20% down. And it's just like the market doing whatever the market does. Like, how do you deal with either the super highs or the super lows of your employees during those times?
Yeah, it's really hard. The great part is on the upswing, it's great because then people are firing on all cylinders.
Yeah. Woohoo. Yeah.
There's no detractors internally. Everyone, it's kumbaya. It is certainly hard one thing when the stock price is sliding, we had a tough time recruiting new executives into the org because the one thing that Wall Street does is it is validating to the public. They either validate you a winner or validate you a loser. And so when that volatility happens in stock price, you've got to sell really, really hard at why this is a great company and why you feel good. You're running twice as fast just to stay in place. So that's certainly a big part. But if I back up and I say, is it better or worse to be a public company? The positives far outweigh the negatives in running a public company. The credibility you mentioned, access to capital. As soon as you become a public company, you have cheaper access to capital than almost every private company.
But do you need access to do you need debt or stuff, or is?
We don't, but let's say if you're a public company and you want to do a large acquisition.
Yeah. Okay. So if you want to acquire something and you want to quickly get $200 million of debt or something.
In 48 hours, you can have it all. Debt, equity, what's the right structure?
Yeah.
Obviously, things have to make sense and logical, but access to the capital markets, both equity and debt, is a tremendous advantage. And the biggest advantage that big tech has over everyone, they can raise money with the cheapest cost of capital. Therefore, they can do any industry that they want aggressively. So, but certainly the positives of being a public company, I encourage everyone, if you're running a company and you have the ability to get public, you should do it.
Because you even think like if your market cap is, $250 million, like you should go public type of thing? Or is
Well,
there some
okay.
sort of threshold
There
where,
probably is a threshold around 500 million. I saw investor interest when we were below 500 million, very low. Hard to fill a room when you're giving presentations.
yeah,
At investor conferences, your meetings get real thin. You got a lot of time for lunch. And I think there's some logic.
right, because they can't own more than 9.9%. So all of
Right.
a sudden, yeah,
And what are your daily trading volumes? If I
yeah,
get in and I need to get out, can I get out? There's all these very logical concerns. But I think around 500 million to a billion, there is a great set of investors that focus on small mid-cap companies that they're deploying money against. And if you are successful, you're going to naturally get the big investors over the course of time when your market cap allows them to get there. So to me, I mean, after having done it, I've raised VC, I've raised private equity, we've raised 150 million of debt, we've taken a company public and accessed public equity. Private capital raises are 10 times harder than public capital raises
yeah,
because you've got so many more credibility questions. Who's your auditor? Tell me more about you. I got to do customer checks. When that public equity side, if you have the ability to cross that chasm, you really should, because it also helps you become a better run company as well. You have quarterly board meetings. You've got to have the materials done. And it really makes you a machine because of the regulatory framework. You've got to be to the right stage. You can't be too small. But if you can do it, we're only today, post-Iris acquisition, we're 380 employees. So we're not a huge company by employee size.
yeah.
But we're $1.3 billion market cap and have a great balance sheet because the public markets enabled us to get public. And I would say, what a great setup if you're running a company to have a great balance sheet, no debt, access to investors overnight almost if you need to. I mean, those are great things to have on speed dial.
Yeah, by the way, your market cap to employee ratio is quite high.
Oh yeah. And then to get on it, once you do pull out of the rut, because we fell in a deep dark hole from 4.4 billion market cap to like 300 million market cap. And we had almost the same amount of cash. So it was effectively zero. I mean, at one point I told investors, if you do the math, we have 350 cents per share of cash. The stock's trading at 335. If you buy the share, it's effectively free.
Yeah.
Like if that's not convincing enough, you just don't.
Right, totally. Yeah.
So a whole bunch of people got in at that time and just made boatloads in pulling out of it. But when you crawl out of that hole, the team that you had in place does feel invincible. And I think that's what creates the next potential trade desk is you go to war and you win and you come out of it stronger for having done it.
Another company that we haven't talked about that I'd be interested in your thoughts on, which is to me like the biggest surprise over the last 10 years is AppLovin. And it's like 100 billion plus market cap. Like, what is your thoughts about like what they did right?
Yeah. I mean, they're the world's best ad network. They're an ad network business model. They've bought a bunch of assets, they bought an SSP, but they operate as an ad network.
Yeah.
And I think what you get there is much more volatility around the revenue and profitability versus a trade desk, which is going to have a lower growth profile, more predictability because self-service DSPs are stickier, but it's a net revenue GAAP accounting reporting.
Yeah.
AppLovin is gross accounting, GAAP revenue reporting. Just that change alone means huge volatility in revenue growth rates. So I think the challenge for AppLovin is can they maintain these unbelievable growth rates?
Unbelievable.
More power to them. But I think what separates both the trade desk and AppLovin, regardless of which business model is best, I have my opinion. If I'm choosing between the two, I go with the trade desk, but I'm biased. We're a self-service DSP.
Yeah.
Versus AppLovin, we used to run specific media, large ad network.
Yeah,
the volatility of having to go re-win budgets quarterly versus training and certifying people on how to use your software. I prefer the trade desk model versus AppLovin. But if you look at public investors, they're saying AppLovin's better, and it's pretty incredible. That being said, the difference of AppLovin and the trade desk versus all other public companies is that those are founder-led businesses, and those are the most valuable public companies, I believe, over the long run. If I'm an investor, if it's founder-run, I'm willing to prescribe more value because I've seen it.
Well, they can make hard
25 years.
decisions. It's a lot easier for them to make hard decisions. They have long-term skin in the game where they're going to own like a fairly large chunk of the company.
All
and
incentives are aligned,
yeah,
and they're the smartest people in the room. And you got to find those two. And I tell everyone that knows myself, my brother Chris, you should buy our stock and make money off of the Vanderhooks, because that's what's cool about the founder-led public companies. You can actually make money off of that person's brain power.
Yeah.
And we may fail and we might suck at it, but after 25 years, we can't fail that bad. So it's, if anything, it peters out. But you should bet on known horses. One of the biggest things I kick myself is looking at the Google valuation when they did a double Dutch auction for their IPO, and I've made fun of it. And they were at a $1 billion valuation, and I just poo-pooed them, but clearly was one of the best businesses ever created of all time. And so I always encourage people in ad tech to invest in other people in ad tech that you think are smart, because you might as well make money off of them.
And it's not, to me, it's not just the founder-led thing per se, but it's just like, what percentage of the business is owned by the CEO and the board, right? Like what percentage, and then the employees, like what percentage of the business is owned by that? And a lot of these companies, it's like 2% is owned by the employees, the CEO, and the board, or something. Like, to me, they're going to have very different incentives for long term. Now, in some other scenarios, you see like the CEO, the board, and the employees own like 50% of the company. Okay, well, now we're much more aligned with how, where the company is going to go.
Well, and I think the comment around founders is founders provide a sense of urgency that no one else can provide.
Yeah.
Through the org. And I think that's what's special is like what keeps me awake at night, the next morning at 8 a.m., I'm emailing that person. We got to get on this. And at 10 o'clock, I'll have a different fear that I'm addressing. And I just think it's that overall sense of urgency. And over time, it plays out in the financial results by having that, call it founder mode or whatever you want, but that autonomy of being the smartest person in the room and the ability to implement change that they know instinctively needs to get put into the business quickly.
You guys also have been a good acquirer. Like you bought Myspace for $38 million just a few years after Newscorp paid $500 million for it. Like, where do you, you don't have to talk about something specific, but where today do you think like the undervalued assets are or sectors that people are just missing?
I mean, we talked about linear TV. I think
linear TV.
Massively undervalued of, so important in society, but the values are pretty low. All things in streaming audio, Spotify, these platforms are going to be huge.
Yeah.
Because what's unique about streaming audio is the niche nature of the content. And that's what's so cool about podcasts is that they can go very niche into B2B applications, data, talking about it. And
World of DAS. This is the most valuable podcast. Yeah.
And when we look at the world of advertising, who has the best products in market today? Meta does. Meta dealt with signal going away across Apple, revenue downturn, and brought it back very fast. And I think we pay attention a lot to how they solve that. In the niche nature of content across social media, that if I'm thinking of men's health and fitness, hitting me with vitamins for guys over 40 is really effective. And I think podcasts have that unique ability to get very, very niche levels of content, which is signal for marketers. And it's going to be a win-win. CPMs are going to go up, revenue is going to go up, and podcasters are going to make more. I think that's a huge, huge area.
But the thing about podcasts is I'm a huge podcast listener. I love podcasts, but it's even in podcasts, like there are plenty of podcasts I listen to. I've never met the host. I don't know the host, but I feel like I do know the host.
That's right.
Like I feel like this person's my friend. I have this relationship with it. And maybe I don't listen to every single one, every single podcast that they do, but like they're almost inviting me to their home. It's this conversational thing. And it's just where I don't have that relationship with anybody else that I don't know.
Definitely. I mean, that I think is the most misunderstood part of social media in general. When you interact in social media, those that are connected to you, they feel like they had a conversation with you, even though
Yep.
you didn't directly. And I noticed this even at dinner, someone would come up and say, "Hey, Tim," and in my head, I'm trying to place them and I can't place them for the life of me. And I realize, oh, and they make a comment and it's like, oh, LinkedIn, they follow me on LinkedIn or over.
Yeah.
over
Oh, yeah. Interesting.
But
Yeah.
I just experienced that myself as well. But that niche nature of podcasts, you're going to see huge value creation in the future.
Interesting. Now, a few personal questions. You founded the company with your brothers in 1999. I think you were like 19 at the time.
Yeah.
Like, what's it like to working with your family? How do those like family dynamics go, et cetera?
You know, I always, when people find out about that, half the people are like, oh my God, I could never work with my brother or sibling. And other people are like, that's amazing. I wish I could.
Yeah.
For us, it was always natural. We shared a bedroom from the time we were like 4.
That's cool.
So we negotiated who was shutting the light off at night every night for our whole life. So for us working together, it's pretty easy because we kind of, you already know when the person's agitated or whatever it may be. I think from a business perspective, though, working with family creates more long-termism in the outlook versus I'm going to build something for 5 years and I'm going to sell it for $100 million.
Yeah.
That approach, which there's nothing wrong with either. Both are good. But I think because we all work together, we had just naturally a more long-term outlook. Like we were never racing to put the business up for sale. And no one, very few times did everyone ever come and say, I want to buy your company. That happened twice, but those are very rare events.
Yeah.
And I think we always felt like being a public company would be the destination that we want. And we always say internally, we want to try and build a company that can last for 100 years. Because that's really hard, a whole nother level to exist. I mean, I won't be running it during that entire time, but we think about the world like that. And then you try and do the right approach that always you don't short circuit anything. It's like, okay, I can make a lot of money this next quarter, or we could do it the right way. We're not going to have the money, but it'll pay dividends for 5 years. And I think we do generally side to long-term approaches.
Okay, I'm going to call you up in 2099 and we're going to have this conversation about it.
Hopefully we're still around.
I hope so as well. Okay, a couple more questions we ask all of our guests. What is the conspiracy theory that you believe?
There is no way there was a single shooter, Lee Harvey Oswald, that took out JFK.
Okay,
so,
that's a very common thing.
It's not possible. It's not possible. I'm the son of a LAPD SWAT. My dad was LAPD SWAT. So just like we've had these debates since the beginning of my life going on. So
he's like, there's no way that guy could be that good.
No way. That you're hitting a moving target with a bolt action rifle and multiple shots, and it's the president of the United States. It just, to me, that's the conspiracy I believe in. There's more than one shooter.
Okay. Yeah. And also, well, the thing that really gets me, I don't know enough about guns and stuff, but it's the Jack Ruby thing where he kills Lee Harvey Oswald a few days later. Like that to me, like creates the whole conspiracy in my head.
Exactly. So yeah, that's
all right. Last question we ask all of our guests: what conventional wisdom or advice do you think is generally bad advice?
What conventional wisdom is bad advice? This might be controversial, but my brother and I do not take the advice that you should not judge a book by its cover. We judge a book by its cover to a large degree because that cover was designed by the person to present them to you. Yeah. Like if I meet someone and they have teardrops tattooed on their face, I'm not second guessing whether that's a real teardrop. I just go with it. I judge the book by its cover. And to me, what people want you to see, the way they present themselves, is accurate 98% of the time. Yes, sometimes you never thought that about someone and it's 2% of the time, but I'd rather be accurate 98% of the time and wrong 2% of the time up front and learn that over time. So for me, we judge a book by its cover in hiring, in the way people present themselves. If you don't present yourself appropriately, you are out. So to me, never listen to that advice of don't judge a book by its cover. Always judge them by the cover.
Always judge. I love that. Yeah. What about when people say something like, do you believe what they like? how do you, like when people just do you try to like uncover like what they're truly motivates people or something like that when you're hiring or whatever?
To me, when I'm hiring and asking questions with people, I'm trying to figure out if this person actually did the work to solve the problem at the other company or the task at hand. There are so many individuals in corporate America that didn't actually do the work, but were in a position that they get credit. And so to me, a lot of my questions are finding out, are you the person who actually implemented this strategy and did it and brought it across the finish line? Because everybody will take credit, but there was one person there that had 85% of the idea and usually were in charge of implementing it as well, because they're the smartest person in the room who came up with it to implement it. So yeah, I mean, we are by nature, my brother and I are generally cynical people, but I think lots of people are cynical. And in ad tech, you got to be cynical in this industry. 90% vaporware everywhere that's out there. 10% of really good businesses, though, and it's harder to identify those.
We used to have a saying that, like in ad tech, like 90% of businesses are ad and 10% are tech. But they're all called ad tech.
Yeah, it's like when Rocket Fuel was around, which is a public company that blew up, and every public investor that I talk to has a Rocket Fuel story. And they used to claim artificial intelligence, and we used to say, it's 0% intelligence and 100% artificial at the time.
All right. Well, thank you, Tim Vanderhook, for joining us on World of DaaS. I follow you on LinkedIn. I definitely encourage our listeners to engage with you there. This has been a ton of fun and a long time coming. I really appreciate you coming on World of DaaS.
Yeah. So I'm so thankful that you had me, Oren. It was great to chat and catch up.
Thanks for listening. If you haven't already done so, please subscribe to World of DaaS wherever you consume your podcasts, YouTube, Apple, Spotify, and more. And please help us get discovered by leaving a review. And check out worldofdaas.com. That's worldofdaas.com. And of course, connect with me on Twitter @Auren. That's AUREN. Would absolutely love to hear from you.